Hey everyone, hopefully having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it. It's generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there, take a look, and see what people are sharing. If you want to follow me at finding score at finding underscore finance. And if you want to join our community, finding-value.com. Guys, this is what I was missing when I was an early investor. I wasn't as well put together as I am today, and I'm still refining my approach. Don't get me wrong; I'm not saying I'm perfect, but when I was younger, I didn't have a strategy. I didn't have a framework to look at the markets through. What this does is it provides a framework for investors, and when we do these weekend meetings, and you're going to have to attend you have to watch a bunch of them. I record all the weekend meetings. I go back. You can look at all of them going back to 2022. There's a lot that provide a ton of training information on there. I look at the markets through the framework of three pillars: ratios, technical analysis, and market cycles. And they are all interconnected. They should all be intertwined. And that's what I was missing when I was a new investor. If I knew what I knew today when I was a new investor and how to approach the markets the way that I do, I would make so much more money. I would have basically a guide of how to approach the markets. The cycles give you the long term big picture view, the ratios tell you where things are cheap or expensive. And then technical analysis is the unbiased way to evaluate the cycle and to evaluate the ratios and tie it all together in an unbiased way. We have a special going on. Special is the coupon code. If you'd like to join, you could try it out for $25 for the first month just to try it out. And if you like it, you can stay on the monthly membership, and it costs a little bit more. It's $50 a month. Or you can swap to the yearly membership, get a discount of $100. For anyone who's on a monthly, you can always switch to the yearly and try it on out. To try it out for a month, that is a steal in my opinion. So coming on down, PSX, what is that? Phillips 66. It's a large energy company. It says need to take out its declining weekly 50 MA green. Yeah. There's some stuff. So basically, this is a falling flag pattern. It's a big move up. It's flagging out, and we're ready to break to the upside. He's got some targets on this. So what I think is coming, it's going to be big. There's drivers behind this cycle that I don't think people are really realizing. The drivers are inflation. Here is my question to everyone. What is going to stop inflation? Most people will say, well, you know how they stopped inflation in previous cycles? I said, okay, tell me. Real estate goes up, they raise interest rates, and they squeeze the borrowers from borrowing money. So they squeeze the housing market, the real estate market, through affordability. And they try to slow down bank lending. Monetary expansion is what that is. It's what's called monetary expansion through the commercial banking system. They squeeze it through raising interest rates naturally in the market. What happens when you've got massive debt as a country? When you have massive debt, your interest payments go way up when you try to slow down inflation through higher interest rates. Then all of a sudden, when you hit certain interest rates, it starts to become more stimulative because they're creating so much money and throwing it out in the world because of the interest payments on the debt that they're stimulating the market and adding to inflation as interest rates go up because of the debt. Energy is the most sensitive to this inflation. Gold is very sensitive. Silver is somewhat sensitive. Platinum is very sensitive too. As we enter into the future, as interest rates go up and they have problems with their debt, it's just going to light these things on fire to the upside. I mean, they're going to light it up. You're going to start to see bullish formations all over the place in energy, in precious metals, and maybe the mining companies. We'll see how they react. They have bullish formations too, and then we're going to see these things just start breaking out everywhere. So that's kind of where we're at. And here's the breakout in this is happening across the world, guys. It's not happening in just America. It's everywhere. So here's Japan. This is the 10-year JGB heading 1.75% breakout. It's happening everywhere. And the debt's going to be a problem. Inflation's going to be a problem. Interest rates are going to roll. And when interest rates go up, if they lose control of interest rates, it's going to devastate stock markets. Stock markets that are overvalued to the yin yang. And what's going to be pressured is going to be hard assets, I think. That's where the pressure is going to be lit underneath. Here's WTIC. It says tempting. It says, I think I'll start scaling in here as we may have a monthly hammer forming off that red ledge. Here's the downside that I see in technical analysis and using only technicals. No one has conviction here in oil. No one. I mean, I do, but no one else has conviction. Why? Because all they're doing is looking at the charts and saying, well, it's got a hammer, it's got support here, but it could still fall, it could do this. Guys, I just described what I think the setup is. A whole bunch of inflation from fiscal spending because of the debt and the higher interest rates. That debt is a problem. It's going to cause inflation, and they're going to have to inflate their way out of this. If you inflate your way out of it, it's going to send oil to the moon. Now, I believe in that thesis. Now, could we get a slowdown in the very short term? Anything's possible in the short term, guys. I'm talking long term here. So I can be aggressive because I believe in a strategy. I believe that they're kind of in a rough place. They being the United States, Powell, the Federal Reserve, Scott Bessent, the government, everybody. And I don't see a way that they're going to solve this thing. What are they going to do? Start getting rid of Medicaid, Medicare, pensions. I mean, they're going to have to dig deep if they're going to do something. They've been abusing the currency system. I mean, they've been abusing it. And this is going to be what rights it. It's going to smoke it. All of this pressure is going to mount in the currency. And this here is oil priced in USD. That's the currency that's going to get hit. They're going to put all that pressure right on the currency. We're going to see massive inflation priced in dollars. And this is happening everywhere. It's all over the place. And here's EQNR. This is the bull pennant. It says, has to overcome its weekly 150 MA, then pop the pattern here. So he's looking at it from a shorter term perspective. I posted to this and I said, well, this is what it looks like to me. This is a 3-hump consolidation going back to the 2000s. 3-hump consolidation, breakout. And what he's showing here is just this upper portion here. This is a retest on top of a breakout. This is your ideal entry point right at this corner here for the technical analysis guys. My ideal entry point is down here, and I'd already be up, maybe not in this stock, but I'm already up 20, 30, 10 to 20 times my money, depending on what it is. And obviously, that's not every company, but that's a lot of them, my better ones. And now we're going to break out again. So this here is a continuation pattern in a bigger bull market. This move here is that right there. If you were to scale it and do the fractal, the projected move, let's look at it. Let's look at the projected move here. I've got this pulled up. This is what I think it's going to do. And this is what it also aligns with absolutely everything in this cycle. So this is 2001. That's this market. So now this doesn't go all the way back to 99, so I don't know how accurate this will be. So this is 2001. So it'll be something on the lines where this goes ballistic goose, something like that, maybe. Something on the lines of that. It's going to go up many hundreds of dollars. Now, we could also do a fib extension I don't know where the bottom is in 99, 2000, but let's just call it like here, there, throw it on up. So we could probably get up to 120 pretty easily, 100, 120, somewhere in that range. But that's the fractal of last one. So not a very good one to use on this one because we don't have the data going back to 99, 2000, where the beginning of the bull market was. Here, still quite the contrast between copper futures and copper stocks. Copper futures breaking out and copper stocks right underneath trying to break out. We still have a move in COPX that could easily break out here. We're at resistance. Investment wisdom, there are only two types of people: those who can't can't market time, and those who don't know that they can't. This is important here. There are only two types of people: those who can't market time and those who don't know that they can't. Warren Buffett says, Charlie and I've never have an opinion about the market because it wouldn't be any good, and it might interfere with the opinions we have that are good. What I will say is, I think there's general areas that you can get for entry points if you use ratios, which is value. And you can also look at market cycles to get you in a general location. So what we can use, and I used it here with Equinor here, this 3-hump consolidation is a consolidation. And if you can buy towards the bottom over here, that's where you can win big. All in that circle there where you can ride it. And now we know that we're in a bull market because we've broken through the consolidation. This is all bull market. It gives you confidence that you should be able to hold during certain periods of time, is what technical analysis. So it's not really timing the market, like timing it in the short term, weeks or months. That's not what you want to use it for. You want to use it for the big picture view like this, in my opinion. That's what I use it for. Coming on back. So here's XLE. This is another energy ETF. I've got a lot of energy stuff in this one. XLE looks ready to move, a massive rally from the 2020 lows, followed by 2 years of consolidation. No breakdowns, no blowouts, just tension building, like a spring slowly winding tighter. This is your bottom. You can draw a line across here. It's actually a shoulder, a head, shoulder, breakout. We've hit some resistance. There is resistance up here for a lot of different areas. I don't know about XLE, but there's your resistance that we've got in XLE here. So that's your resistance that we've got going on there that we're trying to break through. So I think we've got a big move coming ahead of us. I think we are going to go, that last time the resistance was here. Oh my goodness. The last time the resistance was this here. That is equivalent to this here. We pulled back off that resistance back in 2000, 2001. And then we had the big move. So what I think is occurring, this is the beginning of the bull market. There's the fractal here. We throw it up. This is what I think is going to occur. Now, we had a big pullback last time. I don't know if we're going to get that pullback because we've got so much inflation. This fractal is going to look something on the lines of that. You can even see how that lines up. Now, the market condition back then may not be the same as today. You can see the fractal and how this kind of aligns going up and down here. And then I think that we're going to break higher. Why do I think that? Why other people think, oh, we're going to be in a recession and we're going to pull back. Guys, they're printing money and they just continue to load the system with money and money and money. They can't stop it. The system, in order to survive, they got to keep pumping the system. I don't know if we can get these big pullbacks like that anymore because the system can't survive it. So they've been pumping and pumping. So if we were to look at the fractal and what happened next, that is where we would go if we were to do a similar bull market. We would get up to maybe $400. So a 4X on XLE, which is the big boys. That is what I think is where it could go. We could go even higher than that. We could blow this out of the water because of the inflation aspect of it and go way up there. And then I don't know what happens if we hit constraints in energy production. I think that's a possibility. Other people don't think it is. Like, okay, well, we'll find out. When you put money into the system, you stress the system, and then you find out where the weaknesses are in the system. Weaknesses being shortages. We could have shortages in copper. We could have shortages in silver, and that's where you want to put your investments. Is where the shortages are at. It's wherever the system is going to find the shortages first. I think lithium could be a problem. I think copper's a problem. I think silver's a problem. I think oil could be a problem. Most everyone doesn't think oil is going to be a problem. All I'm going to say is this. Here's my question to all you guys who think oil's not going to be a problem. Do you think we can produce oil at 150 million barrels per day? If the answer is no, then we have a problem. Because 150 barrels a day is not that far into the future. Yes, it's in the future. Now, keep lowering it. Do you think we can produce 120 million barrels per day? Probably not. What about 110? I don't know. Now, how far is 110? A few years away. That's it. We could be a few years away from a problem, perhaps. Coming on down, GDX versus the NASDAQ. So I was kind of charting some of this stuff. This looks ready to break out at any second here. This is gold and silver, or gold mining companies, the bigger ones versus the NASDAQ, a composite index. Falling wedge, ready to break. I also priced it against QQQ, which is another ETF for the NASDAQ. That's breaking out right now. Falling wedge, breakout. I think we're at the beginning of this. The beginning of a capital rotation away from financial assets to hard assets and precious metals. I've decided to impose tariffs on white cars and remove tariffs on blue cars. I think it's funny because it's true. He's been flip-flopping these tariffs on, tariffs off. Who knows what's going on? Great Marti, this is the Japanese 10-year. Japan in real trouble. Kamikaze policies coming home to roost. This is about to break and run hard. Inflation's the problem, guys. This is not a deflationary problem. This is inflation. You do not have, this is definitely not deflationary when interest rates are ready to just rip. Dallas Fed on energy survey, 70 is the new $50. The key word to describe 2025 so far is uncertainty. And I'm going to go straight to this here. It says there cannot be U.S. energy dominance and $50 per barrel oil. Those two statements are contradictory. A $50 per barrel oil, we will see U.S. production start to decline immediately and likely significantly. 1 million barrels per day plus within a couple of quarters. This is not energy dominance. The U.S. oil cost curve is in a different place than it was 5 years ago. $70 per barrel is the new $50 per barrel. Sounds about right. Cycle bottom, commodities boom is incoming. JP Morgan upgrades mining sector to overweight, citing rebound in metals price. We've got energy versus tech. Energy looks ridiculously good. We've got a double bottom here playing out. XLE versus XLK, double bottom, ready to rip. This is what I look for. This move here is the exact same move that I made a 20 bagger in some of these other companies. This is it. This is the good one. It's coming. It's going to be big. Zooming in, this is XLE versus the NASDAQ composite. We are starting to break out. This is a shoulder, head, shoulder, bottom, breakout, consolidation, breakout. There's your consolidation, breakout to the upside. Here we go. We're just at the beginning of this move. On the website, I've got companies that will benefit from this. Some of the companies are already off their bottom here by more than 20, 30, 40%. Probably about 20%. 20, 30%. Yeah, 20, 30%. There are ones that are still down in energy service right now that I think are incredibly good entry points that I share on the website there. Rick Rule Rhetoric, he says, most people's sophistication with uranium is simply, when is it going up? People are absolutely, positively loved uranium and couldn't get enough a year and a half ago when the price was higher. They hate it now. And there's nothing I like to see more than hate. It's just sentiment, guys. Negative sentiment. EIA inventory moves. We got a huge drilling boom going on. In fact, it's so big that crude oil declined 3.3 million barrels of inventory. We are down in gasoline 1.4 million, and distillates are down 400,000. Huge boom that we are eating through our inventories pretty dang fast. And we're not even in peak driving season. Good luck when that comes. We can't have the price down here, guys. We're going to eat through our inventories too fast. Price is going to go up. It's too much pressure. Oh, but we've got a little bit of production coming on by Saudi Arabia. They're just trying to slow the price move, guys. They're trying to slow it. It's going to come. HFI Research, repeat after me. U.S. crude oil production is not 13.574 million barrels per day. It is 13.1. Does that look like a drilling boom to you? 13 and a half coming down to 13.1? Not necessarily here, guys. This looks pretty weak. There's real-time U.S. crude oil production tracking. Yeah, we're not getting over 14. Looks like we've got resistance there. Maybe we roll over. We'll see. Christine says we'll be range bound. No strong bull run scenario in the near term, and that's what generalists like. I actually think there's a possibility of a bull run to get us to a level that kind of squashes demand. I don't know if it goes to 80 or 90, but that's a bull run. I don't think we're going to stay down here in the 70s. That's my opinion. It's almost like Permian operators are confirming they will be in production decline and out of low-cost runway sometime between 2 and 5 years from now. Yeah, that's what's coming. XLE, if you want to invest in the SPY or VTI, you're getting like 3% exposure to this. Get those numbers up, playa. Playa. Play on, playa. Yeah, this looks like it's ready to break to the upside anytime. For XLE, it's above support and below resistance, getting squeezed up between the two, ready to rip. And you can see the momentum down here, or I should say the ratio, XLE divided by SPY, breaking to the upside. Just the beginning, playa. Play on, playa. 2025 break-even cost to drill new wells. 66, 70, yeah. And sometimes when it gets around 70, they get shy and they start pulling on back. So I'd say we need oil 80 plus. 80 plus. U.S. domestic steel prices have risen over 30% in 1 month in anticipation of tariffs, higher drilling and new infrastructure costs. So that's going to be even higher for this. Good luck. Let's put in tariffs and raise the price of oil, but let's talk oil down below the break-even cost of absolutely everything in shale. And so we're going to raise inflation for the drilling companies, raise their break-even points, and soon it will be $100 a barrel. Way to go, guys. Good job. Smart thinking. It's a joke, right? The U.S. producer has been wrecked by Trump. And what does this say? The rhetoric from the current administration is not helpful. If the oil price continues to drop, we will shut in production and do quick drilling. Tariffs are reducing activity in the U.S. oil fields. Drill, baby, drill is dead. It's dead. The administration's tariffs immediately increased the cost of our casing and tubing by 25%, even though inventory costs our pipe brokers less. U.S. tubular manufacturers immediately raised their prices to reflect the anticipated tariffs on steel. The threat of $50 oil prices by the administration has caused our firm to reduce its 25 and 26 capital expenditures. Drill Baby Drill does not work with $50 per barrel oil. Rigs will get dropped, employment in the oil industry will decrease, and U.S. oil production will decline as it did in the event of 2019. That's what's coming, guys. Way to go. Way to screw this thing over. And then what he's going to create is a gigantic spike in oil. We don't want a spike. We want $100 oil. We want it to be stable. We want to bring on new supply. This is all causing volatility. It's all very bad. This tariff stuff needs to go. It needs to get kicked out of here, in my opinion. Let's lower the cost for these producers. This is not what an oil bear market looks like. Yeah, is this what an oil bear market looks like, guys? Do you see? These are all deficits. This is the 4-year average deficits from 2021 forward. One little blip of supply add in 2023. That's it. Does that look like drill, baby, drill? Does that look like an oil bear market? Big boys are breaking out. So I use these as leading indicators. So leading indicators, Chevron, breakout. We've got a 300 consolidation in the 1980s. Early 90s, we broke out and we ran in Chevron. This is like the early 90s right here, like 1990. 1990 is what we've got going on here. Big move up. Now, am I using Chevron? No, I'm not. I'm in the smaller stuff that's going to absolutely wax this. That's what I'm in. ConocoPhillips, another one. Here's the fractal of the last one. I grabbed it, compared it. We're right there at the beginning of what is going to be a big move, in my opinion. 300 consolidation, breakout, retest. We're right at the retest, ready to go. GTG, good to go. And here's the ExxonMobil breaking out, ready to rip higher here. Do those look like bearish charts? Why are people bearish? I don't know. They're not doing their homework. They are looking at the back of the book when they were studying this stuff, and they didn't learn enough to get the confidence that's needed to play these markets, in my opinion. And we are on top of consolidations. That's always bullish. And these are our leaders. The leaders are bullish. I'm bullish on the sector. Oil versus Dow Jones Industrial Average. And again, we're breaking out of that. So squeeze, breakout, squeeze. And we're breaking out again. Crude oil versus Dow Jones. So we've got bullish formations and falling wedges. Not enough homework. They were cheating, learning this stuff. Again, there's no magic formula in commodities. Here's a summary from Josh Young on the oil cycle. Here for low prices is low prices. We won't see investment in new production at current prices. Falling oil price, low price, rising price, high price. And then we are here at low prices right now. That is correct. We don't want to invest in low prices, right? We need to get confidence. We need to break some trend lines. We need rising prices so we can invest when it's high prices. Wait, what? I thought we were supposed to be in low prices. We're at low prices. Gold stocks are in breakout mode, so monthly candle charts below, 4 trading days left in the month, but clear and strong breakouts from 4.5-year long basis. As much as I would like to see a pullback or pause, markets can run very hot after breakouts like this. So breakout in GDX, breakout in GDXJ, and GOEX. I don't even know what GOEX is. That's breaking out too. So it's all gold ETFs breaking to the upside of some of these resistance levels. They all look good. Here's GDXJ, another one from Grady, post on the breakout above purple line. Now it's the black line. So we're trying to break out of the horizontal resistance line and really get moving here. This is when things start to speed up. And this is GDXJ. Unchanged arrow was placed when we placed the green dot there, bought heavily at the service there. I did too. I bought all through here. There was certain individual companies that were putting in bottoms in 2022, 2023, and I bought them, and now I'm just riding it up. Up hundreds of percents from those bottoms. Hundreds. Some of them are multi-hundreds. And then they'll probably turn into 10, 20 times my money. I am hoping by the end of this bull market that I've got maybe 10 plus baggers that I've gotten from beginning of bull market to end. Something like that. Hopefully I can do maybe a 20x on the portfolio from bottom of 2020 to the top. Maybe I could do like a 10 to 20x on the entire portfolio. Some on the lines of that. Oil reminds me of where gold was 5 years ago before it exploded from 1280 to 3000. I think we could see something similar in oil over the next 5 years. Totally agree. Like, that is what I think is coming. It's not totally agree. Like, that is what I think. HFI research, our crude storage forecasts. Deficit. Eating through that inventory. XLE, again, another one ready for the breakout. So that's where I'm going to end it, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. That's all I've got for today. So we'll catch you next time. This is Finding Value.